Good morning. My name is Adam Kahn. This used to be the Half-Ass channel, but I think I call it the Rational Investor at this point. I hope everybody's doing well. I know it's a little bit dark out. Hopefully you can see me, well, or maybe it's better you don't. Who knows? So, what's going on in the world now? Oh, let me get into the reason it's so dark is I live here in Las Vegas. It's been 120 degrees most days, and I want to get my walks in. So right now it's like 4 in the morning before the sun comes out and gets too hot for me to go on my walks. So I figured before the sun comes up and it's not too hot, I'll get out there and get my walk in. So hopefully you guys can see okay. Hopefully it's not too distracting. Hopefully it's not annoying, but whatever. I kind of come here to chat for me and get my thoughts out. That being said, not a financial planner. This is just my thoughts on what I see. Please don't use any of it for any decisions you guys make. Use it for entertainment or however you like, but just enjoy. So, what's going on? What's going on with the markets? We got UPS talking about strikes. The Fed's 99.6% or 99.2% chance of raising again, which actually surprises me a little. I'd be tempted to take the bet the other way, even though I know it would lose just because the payout should be so good. But, you know, the economy does seem to be slowing. For those of you who don't know, I do mortgages for a living, and I can tell you we've slowed dramatically. I'm sure some people have left the business already, and I'm sure more will be leaving as well as it continues to slow, because I don't think the Fed really needs to raise anymore for it to continue to choke off the buyers a bit. You know, when I look at monthly payments, they're expensive. So just an interesting phenomenon. I totally get that there's a lack of inventory, because there is. It's interesting to see prices going up and rates at the same time. I totally get the lack of inventory, because I'm one of those people that's stuck in my home in some ways. Don't get me wrong, because I love my home, but we have an interest rate of under 3%. So even if I didn't like our home, where are we going? And if we did go somewhere, I'd be more likely to rent it out than to sell and lose the 3% interest. You know, even me. So those of you who don't understand the math of how mortgages work, it's really front loaded as to paying interest on the home. So if possible, you really want to hold it all 30 years if you have a good interest rate and just pay the monthly payment. You know, paying it off early ends up paying a ton of interest up front, and then you're paying all the principal you originally had to pay off the loan. And that's whether you sell it or if you're in the position to pay it off. You know, I'm really fortunate. We don't have a huge mortgage and could probably pay it off. But I constantly think that how silly I'm actually, if I hold it the whole 30 years, I get to borrow that money at under 3%. And with, I could buy a treasury at 5% and just keep rolling them and take the risk that it lasts longer and that we don't see it drop that far again. You know, I think sometimes when you see what looks like once in a lifetime opportunities, they really might be. You know, I made a comment on somebody else's YouTube, on somebody else's comment, who said something similar in the lines of where rates were and it was an opportunity and hopefully people had a chance to refinance. Well, I refinanced and took out what I could. I called all my clients and suggested the same. The 20% or so that kind of felt like I was just a sales guy trying to make a sale and didn't take the opportunity, you know, I feel kind of bad. And hate that they see things that way, you know. Uh, I like what I do. I'm not going to call somebody and sell them on something just to sell and try to make a living. Give my honest opinion, you know. I even know that I have a different opinion of where we are and what I think. When I talk to my clients now, the last thing I tell them is, gee, I wouldn't worry about it because you can just refinance in time when rates come down. I don't know that I think they're going to come down. You know, Powell's been pretty clear about higher for longer. I'd make sure you're in a good financial position and whatever monthly payment you're taking on, you're okay with, because nobody knows markets. Like, you can make your guess as best as anyone else. Use the economic data, break it down, decide you think X, Y, or Z. But the markets are going to do whatever they're going to do. And that could mean that what the bond market's indicating isn't right. And eventually they'll alter and you'll see a normalized curve. And maybe rates stay where they are. Maybe they drift higher. Maybe we slow too much and the Fed has to reverse and they cut them. But I wouldn't make my bet based on something of, ooh, they're going to cut and you'll be able to get a lower interest rate in time. Especially because even if that's true, maybe it's not as big a cut that people expect, but maybe the pricing of mortgages has higher margins like they have versus the 10-year of recent. You know, historically, or at least the past 10 or 20 years, the general difference between 10-year and a mortgage interest rate is between like 1 3/4 and 2%. Well, right now, if I remember the 10-year, it's like 3.8, 3.9. Well, that would put mortgage rates at 5.9, which I can tell you they're not anywhere close to that. They're closer to like 3-point spread, maybe even a little bit more. I don't know if that's because of the risk that's in there, because quantitative easing stopped and now we're at quantitative tightening, as well as the concern that maybe the Fed raises further, or it's just simple supply and demand and the slowdown. And to pay the bills, the banks need better margins. Like, it all comes into play when it comes to pricing of anything. So maybe the Fed cuts, maybe you don't see mortgages change. Don't know, no way to predict it. And my advice to the people I'm talking to is be comfortable where it is. And if you're buying, don't make a decision based on where you think it will be in the future. So really, I didn't come here this morning and talk about mortgages. If anything, I could talk about the housing market, which is super interesting, but I was more interested in the stock market and what's been going on with it. I'm curious to see if it'll have the legs to continue the way it's been going. You know, I joked with my brother that something ran through the bushes. I don't know what it was. So, you know, it kind of makes me nervous that Meta's back at 300 or thereabout, and some of the other things that have had the moves they've had. You know, those are pretty extreme moves to go from $80 to 300 in, I don't know, 6 months. I understand it fell from 360 to 80 in a short amount of time too, but in some ways I was much more comfortable with it when it was floating around 220, 230, because in my brain it's probably about fair value based on the earnings they're showing. Now maybe they crush it and they own that space, so it's just a stock I want to own. I try not to worry about the valuation. I try not to get stressed when it drops to 80, even though I do. And I try to ignore it when it gets to 300 and don't think, ooh, maybe I should sell and take my profits. You know, when I buy companies, I really try to pick what I think is the best of the best, not what I think is going to go up. And then I just own them the same way I'd own a shirt or anything else. And unless my opinion of that company changes, I just continue to own them. So I'll tell a little story as to why. I probably told it a few times. I don't know if I've posted it. But when I was a kid, was really, well, this will sound backwards because I wasn't fortunate that my grandfather was getting older. I was fortunate that he gave all of his grandkids $10,000 to do whatever we wanted. Now, there are 5 kids in my family, or 4 actually. One's a stepsister, but I think of her as my sister. And I don't remember if he included her or not. He probably did, just knowing him, but really I don't know. Well, it was a ton of money back then, and my mom took it from all of us. I got really upset, and I'm the youngest, and kind of said, Mom, I don't understand why you took it. I'd really like that money. And she says, for what? And I'm sure she took it from all of us. You know, my siblings were older. She probably figured they'd buy a car or spend it on whatever. Well, I wanted to invest it in the stock market. She looked at me a little confused and was like, okay, well, why don't you write a list of the companies you wanted to buy and we'll talk about it. I think I was like, I don't know, 15 or 16. I picked Chrysler. I picked Eastman Kodak. I picked GE. I picked McDonald's. And I can't even remember the other one. I know there were 5, but I've been racking my brain for a long time trying to remember what number 5 was. Well, the funny thing is, if you heard the first 3, now Chrysler went from like $9 or $8 back then to maybe like 12 or 13, and I needed a computer, so I sold it, took the $1,100 and bought a computer and something else, because computer was probably 800 of it. Eastman Kodak no longer exists. GE has floundered and no longer exists in the capacity that it did then. But to be fair, paid a really good dividend for a long time. I want to say I got like either 50 or $100 a quarter for a very long time. Don't remember what I invested, but might have paid for itself. And then there's McDonald's. What's so interesting about it is you already had the stories of McDonald's of, you know, somebody's grandmother put $1,000 in and it was worth millions of dollars. It wasn't like I was early on where I was that. It was already established. And I bought 100 shares. Since then, McDonald's has split 4 times. So 100 to 200, 200 to 400, 400 to 800, 800 to 1600. Unfortunately, I do not have that. Every time it split, I was too excited. I sold 100 shares, thought it was like free money, which it isn't. But McDonald's is like, I don't know, $260 a share. So we're talking about $260 plus another half of that, you know, you $300,000-$400,000 from a $2,000 investment. So even though all the others failed, if I stick to that strategy of picking the companies I think are best, and I hope that at age 51, I'm better at it than I was at age 15. Look at that, that's the opposite. 51 and 15. And I stick with the top companies. If anybody cares or wants to know, you know, I like Facebook, I like Microsoft, I like Google, I like Amazon, Starbucks, Exxon. I have both forms of what I think of as Philip Morris. I have Altria and PM. I have AbbVie. I have Intuitive Surgical, which I like. What other ones do I have? Oh, Bristol Myers, Exxon, Chevron. I try to spread into different sectors. I have a couple that I wouldn't put in that category, but I like. I have Foot Locker because I love the CEO, and I have QSR, which is Burger King and some other brands that I wouldn't say are the top of the top. But for the same reason, I have faith in that CEO as well. So I have that on the horses there. My own Disney, I'm actually tempted to pick up some more as they're going through their troubles. 3M and Dow. You know, some of those may not fit in the top of the top, but to me they are. And I like the array. And then I try not to pick too many. I don't get into the... I do like Tesla. And on this recent pullback, I'll probably pick up some Tesla. I fought it forever, but now that the other American car companies are going to use their charging stations, from what I understand, that's huge to me. I mean, over time, if electric vehicles become more and more dominant, and I don't know that they will, because like anything else, humans don't always think things through so well, and I don't know that we have the capacity to handle the demand if everybody had an electric vehicle. You know, fossil fuels, at least we know there's enough of it to drive the energy that's needed currently. You know, if everybody switched tomorrow, I don't know how much electrical power that takes and how well it would work. But that being said, I think of Tesla as the car company and Exxon all in one. So it's a little bit of a hedge on my bet of Exxon and Chevron, where I feel like I have a bit of the charging stations without taking a guess at the charging station companies and trying to figure out who's going to win in that space or be the best, you know, charge point or this one or that one. And I try not to make too many, what I would say are gambles on those smaller companies. You know, I think their ego plays, that you get to say, oh, I owned this company that was a huge payoff. But, you know, if I just can make 5, 6, 7, 8, 10% a year, that's awesome. So why would I stretch to own the next thing just so I could say I owned it? Because here's the reality. If you buy the next thing, are you really comfortable putting 5% of your money into that bet? And as it goes, are you able to hold on? Or have you put in a small enough amount that you don't worry about it, so that even if it goes, well, yeah, you get to brag, but it's not like you're really gonna hit a home run and make millions of dollars or whatever, because as it becomes 5-10% of your portfolio, do you really hold on that way? Whereas to me, when I buy these stocks, you know, as Meta has gone from 80 or 100 to 300, well, it's a decent percentage of what I have. But I'm convicted enough that, okay, so what? If it goes from 300 to 600 or 1,000 or whatever it is, it just goes. And yeah, maybe I can hold on and it become a home run, or Amazon or this one or that one. And as big as they are already, you know, I've been fortunate to travel the past couple of years. I don't see Amazon all over Europe, and we were just in Asia. I don't think I saw them anywhere out there. So yeah, they're huge. maybe they have the ability to continue to grow in other countries. Maybe more people sign up. I mean, shit, Meta isn't just Facebook. It's Facebook, it's Oculus, it's Instagram, it's WhatsApp. I mean, WhatsApp is huge. I don't even think they monetize on it at this point. So if they figure a way to turn that into profits, that could be bigger than Facebook. I mean, I don't know. People use it to communicate. I don't know if they use their pay system or if they have one, but I bet it's monstrous. So, I don't know. Like a lot of companies, I worry about the Fed. I don't know how far they're going to go or how far they feel they need to. I really was hoping that they would pause longer. You know, the cost of capital really is completely different than it was a year ago. You know, if you want to expand or grow and you have a business and now you're looking at 8, 9, 10, 11, 12% interest rates, that's significantly different than they were 3, 4, 5, 6%. You know, that you have to factor that into your decisions. I mean, I've been explaining to people, you know, some of the lack of inventory that you see in the housing has to do with that as well. You know, who's going to be building houses at the pace that might be needed to meet the demand when the borrowing costs are probably 10, 11% now on a project, and before it was 5 or 6. So your cost to do it was less. You know, the commodities have come down a good bit, so your cost of lumber and things like that are significantly lower. And as the labor market starts to play out, I'm guessing they'll be able to pick up employees at a more reasonable price as well. You know, people are going to need jobs. I think the inflation is slowing. Look, nobody likes the inflation, including me. Nobody. It hurts. But that's what happens. It hurts. And you slow your spending. And as the company's sales begin to drop, well, they need to figure it out too. And from the other end, so do we, whether it's picking up a second job or whatever it is to pay the bills. So if people need a second job or whatever they need to do, or go back to work because maybe too many people are doing Uber and that's getting more competitive, or working remotely changes, or I'm guessing the job market slowly begins to change too, and things quote unquote normalize. I don't know if I see a soft landing or a hard landing. Most of my life, this is more normal than what we saw. You know, if you take not just the pandemic with the free money, but the time before with low interest rates and easy lending, you know, to me that's less normal. When I grew up, economies were tough. People complained. It was hard to get by. You had to work hard to make too little to struggle to pay bills. So as I hear everybody complain and I listen to the stats about credit card debts and borrowing costs and people defaulting and whatever else, I don't know that I think that that's such a miserable economy, or if I think that's what life is normally like, and it isn't always so easy. You know, people have a tendency to spend too much. So if there's then inflation, well, if you're already stretched and things get more expensive, it gets even tougher. So yeah, some people are gonna have to make some real changes and default on some things. my thought was, if the Fed gives it a legitimate 6 or 8 months, I'm guessing the higher cost of borrowing as things roll and loans from 3, 4, and 5 years start to mature and they have to reevaluate at these new rates, that it'll work itself out. I don't know that they need to keep squeezing for it to work out, but I guess they feel that they do, and I guess we'll find out. Exciting week of earnings. We got what I think of as all the big boys, the main ones I've mentioned. My guess is they crush earnings, but they give guidance of it's going to slow down, because probably is. And how do you guide anything different? And this was one other thing I was thinking of that I also had mentioned to my brother that I don't think people always factor in. You know, these companies have a ton of cash, tons. Well, as interest rates go up, their earnings go up because their earnings on the cash has gone up. You know, you go back a year ago and your Apple, with however many billions in cash you have, you're kind of forced to look for companies to take over because you're lucky to get 1% return from the bank on it. You know, odds are they're paying you 0 or 1/4%, even if you're Apple. Whereas now, they're paying you 5%, or you'll just put it in treasuries and roll it every 3 months. And you can do that on a weekly basis if you're worried about having money tied up. And all of a sudden, those billions of dollars are getting 5.25% return. Maybe you're giving a haircut to the bank and doing it at 1/4% less than where CDs are. But there'd be no reason to only be getting the 1 or 2% that the big banks offer. You can cover your risk by spreading them into different CDs all over different banks. You don't have to be at the risky banks the way that Roku was with First Republic. Like, you just don't have to take those. Was it First Republic or was it SB Silicon Valley? I think Silicon Valley. But you just don't have to be putting hundreds of millions in a higher return bank. All you have to do is be buying CDs for yourself to get your 5.25. So I'm guessing the banks would work a deal with you so that they have access to it and can lend it at higher rates. So anyway, my big rant is stick with the plan. Don't let the news scare you out. If the markets go down, markets go down. But generally you get paid for taking risk. So whether it's housing, whether it's stocks, whether it's collectibles, whatever it is, as long as you're still working and where you're working is still doing business, keep making your living, keep putting away, and keep investing. Don't let the news scare you. So have a great Monday. Today's Monday, July 24th. I'm going to try to upload this in a little bit too. Again, my name's Adam Kahn. Have a great day. Have a great week. Maybe I'll chime in tomorrow or the next day. Oh, still recording.